Welcome and thank you for joining us today. We are about to dive into something really exciting. We are talking about the exponential moving average strategy. By the end of this session, you will know how to use the exponential moving average to identify trends, find buy and sell signals, and improve your trading results. Get ready to uncover some great ways to make your trades work better for you. Imagine being able to catch market trends early, riding the wave just as it starts, and knowing when to get out before it turns against you. That is exactly what the exponential moving average can help you do. Unlike the simple moving average, which spreads weight evenly across all data points, the exponential moving average gives more emphasis to the most recent price changes. This makes it more responsive and quicker to react, allowing you to adapt to the market in real time. If you are someone who wants to spot trends early and adjust to shifts with agility, then the exponential moving average is your secret weapon. Are you ready to dive in and see how it can transform your trading approach? Another crucial aspect of using exponential moving averages effectively is understanding how they interact with various chart patterns. By recognizing common chart patterns, you can gain an additional layer of insight into price action and market dynamics. These patterns, when combined with exponential moving averages, allow you to anticipate possible market movements with greater accuracy. Let us explore a few of these patterns more thoroughly to understand how they can enhance your trading strategy. One of the most well-known reversal patterns is the head and shoulders **. This pattern indicates that a trend, especially a bullish one, is about to reverse. It features three peaks, a middle peak, the head, which is the highest, and two lower peaks on either side, the shoulders. When this pattern forms and a bearish exponential moving average crossover occurs, it is a strong indication of a potential downward move. This can be a valuable signal to exit a position or prepare for a potential market downturn. The ** inverse head and shoulders * is the opposite of the head and shoulders pattern and signals a potential bullish reversal. This pattern appears after a prolonged downtrend and suggests that buyers are regaining control. When an inverse head and shoulders pattern forms, combined with a bullish exponential moving average crossover, it can provide an excellent opportunity to enter a long position. ** double tops ** and ** double bottoms * are also crucial reversal patterns to understand. A double top resembles the shape of the letter M and typically forms at the end of an uptrend, suggesting a shift from bullish to bearish momentum. When this pattern appears along with a bearish crossover of exponential moving averages, it is a reliable indication that the price might begin to fall. Conversely, a ** double bottom **, which looks like a W, appears after a downtrend and signals that the bearish momentum is weakening. A bullish crossover during a double bottom formation can be an effective indicator for initiating a long position. ** triangles **, whether ascending, descending, or symmetrical, are often seen during periods of market consolidation and can indicate an upcoming breakout. An ** ascending triangle * forms when there is a flat upper trend line and a rising lower trend line, suggesting accumulating buying pressure. A breakout above the upper trend line, especially when confirmed by a bullish exponential moving average crossover, provides a strong buying signal. A ** descending triangle * features a flat lower trend line and a descending upper trend line, indicating building selling pressure. A breakdown below the lower trend line, accompanied by a bearish crossover, can serve as a reliable signal for shorting. Asterisk asterisk symmetrical triangles asterisk asterisk represent indecision in the market, and when a breakout happens, whether upwards or downwards, the direction can be confirmed with an exponential moving average crossover to increase the reliability of the signal. Asterisk asterisk flags asterisk asterisk and asterisk asterisk pennants asterisk asterisk are continuation patterns that form after a strong price movement, suggesting that the trend will continue in the same direction after a brief pause. A asterisk asterisk flag asterisk asterisk appears as a small rectangular channel that slopes against the prevailing trend, while a asterisk asterisk pennant asterisk asterisk resembles a small triangle with converging trend lines. These patterns typically form after a sharp movement, and the consolidation represents a pause before the trend resumes. If an exponential moving average crossover aligns with the breakout from a flag or pennant, it often indicates a good time to enter the trade in the direction of the prevailing trend. Asterisk asterisk wedges asterisk asterisk are similar to triangles, but are characterized by sloping trend lines that either converge upward or downward. A asterisk asterisk rising wedge asterisk asterisk is generally considered a bearish pattern, indicating that the current uptrend is losing momentum and may reverse. When a bearish crossover of the exponential moving averages occurs within a rising wedge, it often provides a strong sell signal. A asterisk asterisk falling wedge asterisk asterisk, on the other hand, suggests a bullish reversal as sellers lose momentum. A bullish exponential moving average crossover during a falling wedge can serve as a highly effective buy signal. The asterisk asterisk rounding bottom asterisk asterisk and asterisk asterisk rounding top asterisk asterisk are patterns that form more gradually than other reversal patterns. A asterisk asterisk rounding bottom asterisk asterisk resembles a bowl shape and indicates a slow shift from bearish to bullish sentiment. When a bullish exponential moving average crossover takes place during a rounding bottom, it is often a strong signal to enter a long position. Conversely, a asterisk asterisk rounding top asterisk asterisk signals a gradual reversal from a bullish trend to a bearish one. When accompanied by a bearish crossover, it can serve as a clear signal to consider selling. Another continuation pattern worth mentioning is the asterisk asterisk cup and handle asterisk asterisk. This pattern resembles a teacup where the asterisk asterisk cup asterisk asterisk is a rounding bottom and the asterisk asterisk handle asterisk asterisk forms a short consolidation period, often sloping slightly downward. When a breakout occurs after the handle, especially if accompanied by a bullish exponential moving average crossover, it is a strong signal to buy, as it indicates the continuation of an uptrend. By being thorough in understanding these chart patterns and their interactions with exponential moving average crossovers, you can significantly improve your ability to make informed trading decisions. Chart patterns not only provide an additional layer of analysis, but also help confirm whether trends are strengthening or losing momentum. Using these patterns alongside exponential moving averages allows you to create a robust trading strategy that considers multiple facets of market behavior, giving you a powerful edge in timing your entry and exit points. Are you excited to incorporate these chart patterns into your trading strategy to enhance your success? Another important aspect to consider when using exponential moving averages is recognizing common chart patterns. Chart patterns can add an extra layer of insight to your trading decisions, and when combined with exponential moving averages, they provide a clearer picture of market trends and turning points. Some of the most useful patterns to recognize include head and shoulders, double tops and bottoms, triangles, and flags. Let us go over each of these briefly so you can understand how they work. The head and shoulders pattern is a reversal pattern that can indicate a change in trend direction. It is composed of 3 peaks, a higher peak in the middle, the head, and 2 lower peaks on either side, the shoulders. When you see this pattern forming, especially along with an exponential moving average crossover, it is a strong signal that the market may be about to reverse direction. Double tops and double bottoms are also reversal patterns. A double top looks like an M and suggests that a bullish trend is losing momentum and might reverse into a bearish trend. A double bottom looks like a W and indicates that a bearish trend might be reversing into a bullish trend. When these patterns form near exponential moving averages, they can provide strong buy or sell signals. Triangle patterns, including ascending, descending, and symmetrical triangles, show consolidation in price and can indicate that a breakout is about to happen. Ascending triangles are typically bullish, descending triangles are bearish, and symmetrical triangles can break out in either direction. Watching how these patterns interact with exponential moving averages can help you identify potential breakout points and confirm the trend direction. Flags are continuation patterns that show brief pauses in a strong trend. They appear as small channels moving against the prevailing trend, and once the flag completes, the trend is likely to continue in the same direction. If a flag forms while the price is interacting with an exponential moving average, it can be a sign that the trend is about to resume. By adding these chart patterns to your toolkit, you will be able to get a more complete understanding of what is happening in the market. When combined with exponential moving averages, these patterns help confirm trends, identify entry and exit points, and manage risk more effectively. Are you ready to start looking for these patterns on your charts? Now let us set up this exponential moving average strategy. To do this, you will need to choose the right time frames. Most traders like to use 2 different exponential moving averages, one for the short term and one for the long term. A common setup is using a 12-day exponential moving average for short-term trends and a 26-day exponential moving average for longer-term trends. It is really easy to add these to your chart, and most trading platforms let you do this quickly. You just pick the time periods for your exponential moving averages, add them to the chart, and watch how the price interacts with the lines. When you see how the price dances around the lines, it starts to make sense. Are you ready to try this out? Once we have our exponential moving averages set, we can look for something called crossovers. Crossovers can give us a great idea of when to buy or sell. Let us start with a buy signal. A buy signal happens when the short-term exponential moving average crosses above the long-term exponential moving average. This suggests that an upward trend may be starting, and it might be a good time to buy. On the other hand, a sell signal happens when the short-term exponential moving average crosses below the long-term exponential moving average. This tells us a downtrend may be starting, and it might be time to sell or step away. For example, if you see the 12-day exponential moving average crossing above the 26-day exponential moving average, this shows that momentum is shifting up. Many traders see this as a good time to buy. However, crossovers can be even more powerful when you understand the context provided by various chart patterns. Let us explore how some common chart patterns work with exponential moving average crossovers to give more reliable signals. One important pattern to consider is the *** head and shoulders ** pattern, which is a reversal pattern often signaling that an existing trend is about to reverse. If you see a head and shoulders pattern form along with a bearish crossover of the exponential moving averages, it is a strong indication that the market may be shifting from an uptrend to a downtrend. This is a key opportunity to consider selling or exiting your position before the price declines further. Another useful reversal pattern is the *** double top and *** double bottom ***. The double top resembles the shape of an M and appears at the peak of an uptrend, suggesting that the bullish trend is losing momentum and may reverse. When a double top forms along with a bearish crossover of the exponential moving averages, it serves as a strong signal that it is time to sell or take profits. Conversely, a double bottom looks like the letter W and suggests a bullish reversal after a downtrend. When this pattern appears along with a bullish crossover of the exponential moving averages, it often signals a great buying opportunity. *** triangle patterns ** are also crucial in conjunction with crossovers. There are three types: ascending, descending, and symmetrical triangles. Ascending triangles have a flat top and rising bottom, and they often lead to a bullish breakout. When you see an ascending triangle along with a bullish crossover, it confirms a potential upward breakout. A ** descending triangle ** has a flat bottom and descending top, suggesting bearish momentum. If you notice a descending triangle along with a bearish crossover of exponential moving averages, it indicates an upcoming downward breakout. ** symmetrical triangles **, on the other hand, can break out in either direction. When combined with an exponential moving average crossover, symmetrical triangles provide an excellent confirmation of the direction of the breakout. ** flags and pennants * are continuation patterns that typically appear after a strong price movement, signaling that the trend will likely continue in the same direction. A ** flag * looks like a small rectangular channel that slopes against the trend, while a ** pennant * looks like a small symmetrical triangle. Both patterns are formed during a brief consolidation after a sharp move. If a bullish crossover appears while a flag or pennant is forming, it suggests that the trend will continue, making it a great time to enter the trade. ** wedges * are another significant chart pattern that can either indicate continuation or reversal, depending on their formation. A ** rising wedge * occurs when the price makes higher highs and higher lows, but within converging trend lines, indicating a loss of momentum. This pattern often signals a bearish reversal, especially when confirmed by a bearish crossover of exponential moving averages. Conversely, a ** falling wedge * occurs when the price makes lower highs and lower lows within converging trend lines, suggesting that a bullish reversal is likely. When combined with a bullish exponential moving average crossover, the falling wedge provides a strong buy signal. Another valuable chart pattern is the ** rounding bottom * or ** rounding top **. A rounding bottom looks like a bowl and indicates a gradual shift from a bearish trend to a bullish trend. When a bullish crossover occurs during the formation of a rounding bottom, it is often a strong signal to enter a long position. On the other hand, a ** rounding top * suggests that a bullish trend may be coming to an end and reversing into a bearish trend, especially if confirmed by a bearish exponential moving average crossover. By incorporating these chart patterns into your analysis, you can greatly improve the accuracy of your crossover signals. The combination of exponential moving average crossovers with chart patterns helps to confirm whether a trend is gaining momentum or is at risk of reversing. This multi-layered approach gives you a deeper understanding of market dynamics, allowing you to make more informed and confident trading decisions. Are you ready to start adding these chart patterns into your strategy to strengthen your trades? Let us also take some time to understand how chart patterns can enhance our interpretation of crossovers. Chart patterns can provide additional context to crossovers, making them more reliable and giving you a better understanding of the current market situation. Some key chart patterns to watch for include head and shoulders, double tops and bottoms, triangles, and flags. The head and shoulders pattern is a reliable reversal pattern that signals a trend change. When combined with exponential moving average crossovers, it can be a powerful indicator of when a trend is about to reverse. For example, if you see a head and shoulders pattern forming along with a bearish crossover, it is a strong signal that the market is likely to move downwards. Double tops and double bottoms are other reversal patterns that can add depth to your analysis. A double top, which resembles the letter M, is an indication that an uptrend is losing strength and might reverse. A double bottom, which looks like a W, shows that a downtrend might be coming to an end and an upward trend could be starting. When you see a double bottom forming and it coincides with a bullish crossover, this can be a highly reliable buy signal. Triangles are consolidation patterns that indicate a breakout is coming. Ascending triangles often signal bullish breakouts, while descending triangles suggest bearish moves. Symmetrical triangles can break out in either direction, depending on market momentum. Crossovers that occur near these patterns can help you confirm the direction of the breakout and make a more informed decision. Flags are continuation patterns that form after a strong price movement. They are small channels that slope against the prevailing trend and indicate that the market is taking a short breather before continuing in the same direction. If a bullish crossover occurs while a flag pattern is forming, it is often a good indication that the price will continue moving upward. By combining these chart patterns with crossover signals, you can gain a better sense of market dynamics and make more informed trading decisions. The interaction between chart patterns and exponential moving averages helps confirm whether a trend is truly gaining momentum or losing steam. Are you ready to start adding these powerful tools to your trading strategy? But when should you enter or exit a trade using this strategy? For entry points, it is best to wait for a bullish crossover. That means the short-term exponential moving average moves above the long-term one, which shows that a new trend may be forming. For an exit point, look for a bearish crossover when the short-term exponential moving average drops below the long-term exponential moving average. This tells us the trend may be reversing, and it is time to think about taking profits or minimizing losses. Always remember to set a stop loss to manage your risk. Many traders put their stop loss just below recent support levels or under the long-term exponential moving average. This can help protect you in case the market takes an unexpected turn. Now we can make the exponential moving average strategy even more powerful by combining it with other indicators. One popular choice is the Relative Strength Index, also called the Relative Strength Index. This tool can help confirm your trades. If you see a bullish crossover and the relative strength index tells you that the asset is oversold, then that can be a really strong buy signal. Another good indicator to use is the moving average convergence divergence. The moving average convergence divergence works well with exponential moving averages. If the moving average convergence divergence line crosses above the signal line during a bullish crossover, it is a strong confirmation of the trend. Volume is another important factor. If there is high volume during a crossover, it means that the trend has strong backing. If the volume is low, it could mean that the move is not as strong. In addition to these indicators, understanding chart patterns can significantly enhance your ability to interpret signals and make more informed trading decisions. Let us dive into some of the most common chart patterns that can help you in conjunction with exponential moving averages. One of the most well-known patterns is the head and shoulders pattern. This is a reversal pattern that consists of 3 peaks. The middle peak is the highest and represents the head, while the 2 lower peaks on either side are the shoulders. When you see this pattern forming, especially along with a bearish exponential moving average crossover, it indicates a potential trend reversal from bullish to bearish. This is a powerful signal to consider exiting a position or preparing for a downtrend. Another key reversal pattern is the double top and double bottom. A double top resembles the shape of the letter M and usually appears at the peak of an upward trend, signaling that the bullish trend is losing momentum and a reversal is likely. On the other hand, a double bottom looks like the letter W and signals a potential reversal of a bearish trend into a bullish one. These patterns, when seen in combination with bullish or bearish crossovers, can give you a highly reliable signal for entering or exiting trades. Triangles are another crucial pattern to understand, and they come in 3 forms: ascending, descending, and symmetrical. Ascending triangles are formed by a flat upper trend line and a rising lower trend line, indicating that buyers are gaining strength. A breakout above the upper trend line can signal a strong bullish move, especially when confirmed by an exponential moving average crossover. Descending triangles, which have a flat lower trend line and a descending upper trend line, are the opposite, signaling bearish pressure. Symmetrical triangles formed by converging trend lines can break out in either direction, and exponential moving average crossovers can help confirm the direction of the breakout. Flags and pennants are continuation patterns that are often seen after a strong price movement. A flag looks like a small rectangle that slopes against the prevailing trend, while a pennant resembles a small symmetrical triangle. Both of these patterns suggest that the market is taking a brief pause before continuing in the same direction. If you see a bullish flag along with an exponential moving average crossover, it is often a good indication that the price will resume its upward movement, providing an ideal opportunity to enter the market. Wedges are another type of chart pattern that can signal either continuation or reversal, depending on the context. Rising wedges, where the trend lines converge upwards, typically indicate a bearish reversal, especially if the price breaks below the wedge accompanied by a bearish crossover of the exponential moving averages. Falling wedges, on the other hand, often signal a bullish reversal, particularly when the price breaks out to the upside with a bullish crossover. Rounding bottoms and rounding tops are also helpful patterns to identify potential trend changes. A rounding bottom, which looks like a bowl, indicates a slow shift from a bearish trend to a bullish trend. When a bullish exponential moving average crossover occurs during the formation of a rounding bottom, it can be a strong signal to enter a long position. Conversely, a rounding top suggests a potential bearish reversal, especially if confirmed by a bearish crossover. By thoroughly understanding these chart patterns and combining them with exponential moving average crossovers, you can significantly improve your ability to spot reliable trade opportunities. Each pattern provides a different perspective on price action, and when used alongside other indicators like the relative strength index, moving average convergence, divergence, and volume, you gain a well-rounded view of market dynamics. Are you ready to start applying these chart patterns to your trading strategy and see how they work in real time? This strategy can be used in different ways depending on your trading style. Day traders like to use shorter exponential moving averages like 5-day and 10-day. This helps them catch quick market moves. If you are a day trader, you need tools that respond fast, and these short-term exponential moving averages will help you make faster decisions. If you are a swing trader, the 12-day and 26-day exponential moving averages work well. These are better for finding trends that last for several days or even a few weeks. You do not need to watch the market all the time, but you can still catch trends as they happen. And for long-term investors, longer exponential moving averages like 50-day and 200-day are best. These help you spot major market trends and avoid getting caught in short-term noise. There are some common mistakes that people make when using this strategy, and we want to help you avoid them. First, do not act on every crossover. Not all crossovers are reliable. You should always wait for confirmation from other indicators like volume or the relative strength index. Another mistake is ignoring other market conditions. Even though the exponential moving average is a great tool, it is important to look at the bigger picture. Things like market news, economic conditions, or earnings reports can affect the price. A common mistake many traders make is also failing to recognize chart patterns properly or ignoring them altogether. Chart patterns, as we discussed earlier, can provide strong context for what the market is doing and can make exponential moving average signals much more reliable. For example, seeing a double top pattern along with a bearish crossover is far more convincing than just seeing the crossover by itself. Learning to identify and interpret these patterns alongside exponential moving averages is crucial for reducing false signals and improving your decision-making process. Another mistake is relying solely on exponential moving averages without combining them with other tools. Indicators like the relative strength index, moving average convergence, divergence, and volume are all helpful in providing additional confirmation. Ignoring these can lead to missed opportunities or, even worse, entering trades based on weak signals. Finally, do not forget to set stop losses. Even if the exponential moving average strategy looks strong, the market can still move against you. Stop losses help protect your trades from sudden market reversals and prevent significant losses, especially during volatile market conditions. Before you jump into live trading, it is always a good idea to practice using a demo account. A demo account is a great way to learn without risking real money. You can get familiar with spotting crossovers, trend reversals, and support and resistance levels. Another great habit is to track your results. Keep a trading journal to record every trade you make using the exponential moving average strategy. Note down what worked and what did not. Over time, you will be able to see patterns and make improvements. It is also a good idea to experiment with different time frames. Try different combinations of short-term and long-term exponential moving averages and find out what works best for your style. Let us do a quick recap of what we have learned today. The exponential moving average strategy uses two exponential moving averages, one for the short term and one for the long term. to find buy and sell signals. A bullish crossover signals a buy opportunity, while a bearish crossover signals a time to sell. Start by practicing with the 12-day and 26-day exponential moving averages. Confirm your trades with other indicators like the relative strength index or moving average convergence divergence. And do not forget to use stop losses to manage risk. Additionally, we have explored how chart patterns can significantly enhance the effectiveness of the exponential moving average strategy. Recognizing patterns like head and shoulders, double tops and bottoms, triangles, flags, pennants, wedges, and rounding formations helps provide a more complete picture of market dynamics. These patterns can indicate potential reversals or continuations, and, when combined with crossovers, create more reliable trading signals. For instance, head and shoulders patterns can signal trend reversals, while flags and pennants are powerful continuation patterns. Triangles can signal impending breakouts, and wedges can indicate both continuation and reversal, depending on the price movement. By identifying these patterns, you can reduce false signals and strengthen your trading decisions. Understanding how these chart patterns interact with exponential moving averages gives you a powerful edge in determining entry and exit points with greater accuracy. The exponential moving average strategy is simple but powerful. With practice, you can become more confident in using it to make smart trading decisions. Keep practicing and refining your strategy, and over time, you will see improvements in your trading.